this video on the state and macroeconomic policies. So in this video, we're going to look at the role of the state in introducing macroeconomic policies and look at a few issues. So let's start off with a quick reminder of what we mean by the state and what we mean by macroeconomic policies. So when we're talking about the state, normally we think of the government. So these are in democratic societies comprised of elected representatives who make decisions on behalf of society. The state can also involve local authorities, so your local council, who are responsible for things like the libraries, collecting the rubbish, all that sort of stuff. It could also involve any other governmental bodies, for example, regulators. They're not really the government or the local authority, but they're still part of what we would describe as being the state. Likewise, public corporations. We would also say that the central bank is part of the state, but as we'll see later on, sometimes this operates by itself in an independent capacity. Let's also remind ourselves of the policies the states have up their sleeve to use to try and influence the economy. We have monetary policy, so the setting of interest rates, exchange rates, quantitative easing, reserve ratios. We have fiscal policy, so government spending and government taxation, different types of taxation, national debt, budget deficits, and so on. And we also have supply side and legal legislation that the government can use. So we have interventionist and free market supply side policies, and also laws. So as we go through this video, we're going to look at a few key issues: independent central banks, different policies for different objectives, some of the difficulties that policymakers face, and then lastly, the idea of external shocks. So as we said before, the state involves both the government and also the central bank. Now, in many countries, previously in the past, and also still in the case in many developing countries, is that there are very close relationship between the government and the central bank. So for example, the politicians who are in charge of the government, maybe the president, can also dictate what the central bank does in terms of exchange rates, interest rates, quantitative easing, and so on. There's quite a close relationship. What we increasingly see in developed, more advanced economies over the last 20 or 30 years is there's been a very clear separation, a divorce from the state of the central bank. It has its own head, it operates independently, its independence is enshrined in legislation, and the government cannot influence how the central bank is acting. The government may provide the central bank with a target, so for example, to keep low and stable inflation, but they don't interfere with the operations, and the central bank doesn't necessarily have to listen to the government. And we call this the independent central bank approach. This chart shows us some quite interesting information about how successful that has been. This analysis at the bottom here gave a score of central bank independence, so saying how independent has that central bank been over a long period of time. So this stretches back from 1950 all the way till the 1990s. And we can see that the USA, Switzerland, Germany, Canada, these countries score quite highly in terms of how independent their central bank is. Countries at this end, like Portugal and Greece, they score more lowly on terms of how independent their central bank is. And when you look at the average inflation rate these economies have experienced, we can see that there is a general correlation here that the more independent the central bank, the more successful that country has been at keeping low and stable inflation. So let's explore that idea a little bit further. Countries that do not have independent central banks often experience quite significant economic cycles, periods of boom and bust. And the theory goes that in the run-up to elections, politicians may be tempted to increase government spending or cut taxes, cut interest rates, or increase the money supply to make the economy appear better so that they get re-elected. However, this only creates inflationary pressure, destabilizes the economy, creating more booms and busts, which lead to less confidence and overall a less well-performing economy. This phenomenon is often known as the political business cycle. where politicians are influencing, causing the booms and busts through how they manipulate monetary policy and fiscal policy in the run-up to elections. When the central bank is independent, this is not necessarily going to happen. And over the past decade, there's definitely been a trend towards increasing the independence of central banks as a way of improving economic performance. How it normally works is the government provides a central bank with a clear long-term target, for example, close to but below 2% or 2% inflation target, but it's up to the central bank to implement policies as they see fit. So they don't have to react to elections, they just meet their target, that's their sole purpose. And this operational independence is normally enshrined in law. We might question, however, how independent the central bank could ever be, because ultimately it's the government who appoint the directors at the central bank, and ultimately the central bank is responsible or accountable to the government. A second issue we're going to consider is different policies for different objectives. So we know that we have policies government can introduce to try and achieve certain objectives. But which would be the most appropriate policy given what situation? So for example, we know that governments often want to balance their budgets, and this would be related to fiscal policy. Low and stable inflation would be more related to monetary policy and influencing the level of spending in the economy through interest rates and the money supply. If we want economic growth and development, then we might focus more on supply side policies to expand the productive potential of the economy. So we need to appreciate that for different objectives, we would choose perhaps different policies. We should also bear in mind that sometimes these policies conflict. So for example, during the recent financial crisis, many countries were running contractionary fiscal policy to deal with national debt, but they were also running expansionary monetary policy to deal with stagnating economic growth. So what is going to be the net effect here? If we're having a net withdrawal from the economy through our fiscal policy, but having a net injection through our monetary policy, will they cancel out? Are they going to mean that one policy is not going to be as effective as it might be? We also need to consider some of the problems that governments face or policymakers face when trying to decide on which macroeconomic policies to introduce or to change. The first issue is to do with the quality of the information on which they base their decision. We know that the Monetary Policy Committee, for example, are trying to predict what inflation and the economy will be like in 2 years' time, and they're basing that on data that they receive today. They might base that on the latest GDP figures, but we know that GDP is only an estimate and is revised after it is released. CPI, again, is only an estimate. It's this basket of goods, doesn't tell us inflation for any particular person or across all goods and services. HDI, again, is trying to tell us something about our levels of development, but it doesn't tell us anything about the quality of life or the quality of education. So this is a good note to remember for when you're doing your exams. We can always question the information given in the extracts, and that's a nice way to make evaluation points. Secondly is about risk and uncertainty. So there's uncertainties about how these policies will, people in the economy will react to these policies. So for example, if I raise income tax as a government by 3%, how much will people cut back on their spending? What will be the impact on how much disposable income is spent and how much is saved? Will the policy I introduce have any unintended consequences? What are the risks of that? What are the uncertainties that I'm dealing with in the economy? And lastly, there's always the issue of something out of our control that we just can't foresee or prevent. For example, a sudden recession or something like the credit crunch. So let's look on now and look at some examples of external shocks, things that happen to the economy that policymakers will find it very difficult to respond to. If we cast our minds way back to the 1970s, where none of you were probably born, in fact certainly weren't, there was something called the oil price crisis. Now this happened when there was geopolitical issues and the OPEC countries cut off oil supply. This caused oil prices to surge, to rise significantly, and there to be a lack of oil. In those days, the economy was very dependent on oil. This has had a massive impact, a huge supply side shock, raising inflation, reducing economic growth, causing stagflation. This is such a big shock, it's very difficult for government policymakers to do anything about it. In the early 1990s, when the UK was subject to a speculative attack by George Soros and plunged out of the exchange rate mechanism, this really destabilized the currency, destabilized the exchange rates in interest rates, and caused a big shock to the economy, which was very difficult for policymakers to deal with. We see this throughout history. In the UK in the early 1990s again, house price crisis or house price crash, and the effect this has in terms of the wealth effect and the psychology of people within the economy. Again, it can be very difficult for policymakers to deal with this. Another example in the late 90s would be the Asian financial crisis. Again, speculative attacks on Asian currencies led to significant falls in their value. We can see here some currencies falling by up to 60% in their value. This is very difficult for policymakers in those countries to deal with. The flash crash, this was caused by automated algorithmic trading of shares. And on one afternoon, back in May 2010, the stock markets lost a significant value in a very short pace of time. Again, this is completely outside of the control of policymakers. A fall in share prices affects businesses, affects pensions, affects investors. Around the same time, we also had the credit crunch. Banks running out of finance, not lending to each other, not making loans to the economy has significant impacts on investment, significant impacts on consumption, significant impacts on economic growth. And how do policymakers, how do they respond to this? Again, it's very difficult. This in turn led to the national debt crisis that we saw around many European countries. Again, this is very difficult for policymakers to deal with. How can they address a budget deficit while also trying to address stagnating growth and the drying up of financial markets? So often we see many external shocks to the economy that are having big impacts that's very difficult for policymakers to respond to. So in this video, we've looked at the role of the state more generally in their use of macroeconomic policies. That's it. Thanks very much for listening.